Good morning, guys.
Good morning. So did you get this place on points or?
No, got it as a gift.
Nice.
Yeah, someone hooked
Peter's
us
a cool
up
guy.
because we needed somewhere to record.
Yeah.
And usually when we go to a city, we book an Airbnb. But I think
I
you're doing
that's what I was expecting you guys to be an Airbnb.
But you here you can't the kind of thing you need. You're off strip.
Or you're in a condo.
Yeah.
Yeah.
And so if you're going to meet people and do shows and go for dinner, it's like it's good to be
it's
central. And I spoke to a friend of mine. He said, "I can get you a place here." And so it's perfect for us. Size-wise, it's about what we have in an Airbnb, but as a hotel room, it's fucking jokes.
Yeah, this is just right. This is exactly what you need.
When do we ever get an Airbnb this big? It's massive.
That one in Malibu that you guys had when I first came on the show
was
this
pretty
big,
sweet. But it was pretty sweet.
That was
nice,
pretty sweet.
Yeah. That's when Hoddle drunk all my mitches.
Yeah, that was fun.
He was so drunk on that show.
Fuck. Yeah. Did he fall asleep at it?
No, it's probably you.
Almost, yeah. I think he did.
But we've had some decent sized
Yeah,
ones.
we have. But this nothing like this.
Yeah, this is great. This is awesome. And we feel very lucky. Anyway, good to see you both.
Good to see you, man.
Good to pair you both up. Do you guys know each other already?
We've had a few interactions, but
we've talked on the phone.
My first podcast with the Lav Dog. I'm ready to rip it.
We've got the young buck with you.
I'm the young buck.
What is it? The old.
You're
bull?
looking at me.
I was. Right. We had a dinner last night. And we were talking a little bit about TradFi people. So I kind of want to start there.
Yeah.
Because you kind of both have had a different experience. You're saying the TradFi people are still laughing, like they don't get it, whereas you're saying some of them are coming over.
It's kind of both, right? So I mean, you come from private equity. I come from hedge fund world. Similar, slightly different, lens on how to invest, but I did a little bit of I did a lot of private equity too. But
how are they different? So people listening who aren't in the finance world.
Well, for the hedge fund world, it's super liquid. Typically, you're doing levered trades, you're doing paired trades, you're doing a lot of hedging, hedge fund, and you have a shorter time horizon typically, and you're looking for inefficiencies that you're just taking advantage of. In the private equity world, you're looking for deep value, something that you can invest in for years. And there's different types of it, and Eric can go into it more than me. But you've got control positions, you've got non-control positions, and which you can influence the outcome of the investment. You can help, you can sit on the board. So it's a little bit more active typically, and it's a longer time horizon. So now I've got a hedge fund and a private equity unit within the same. So it's kind of a hybrid. So we're doing the same. We're doing a little bit of both.
Right. And in a venture fund, they typically wouldn't just be buying Bitcoin. They would be investing in companies and maybe Bitcoin companies, whereas a hedge fund could be directly buying Bitcoin as part of their strategy.
Yeah. Part of your strategy, and part of our strategy has been to put a substantial portion of our treasury in Bitcoin as we're looking for investments on both the public and private side. So
well played. Yeah. Good timing.
What's crazy about it is that, it's like anything, the world is on sale. And if it was Walmart, if it was Amazon, Black Friday, everybody's lining up. But if it's the stock market, if it's Bitcoin, people are fleeing. And it's just like the people we talked about, So, but I mean, it's the same thing. I'm sure that's it. So it was difficult to raise money in that environment, but we are extremely happy with how well we did and what we're doing. And we're excited. I mean, I can't be more excited about the opportunities.
Yeah, well, we will dig into that.
Yeah.
I think we've all experienced over the last few years, I mean, we've all come into this at different times, but that we've all kind of witnessed, there's a bit of a reluctance from TradFi people to get involved. They still don't get it. But with the birth of these ETFs, I kind of felt like this would be the time where everyone from TradFi would be like, oh, holy shit, now I need to at least look at this. And I need to take this thing seriously, especially with the inflows. Yeah. You've still got people in TradFi.
Yeah, I want to hear what you're seeing first.
Yeah. I think I guess one other point too that I want to add to the comments you're just making, from the hedge fund is a very broad term at this point. It's like it originated with a certain style of investing, and then it's kind of emerged into just like broader public market asset allocation with more like strategic focused strategies. Whereas like the execution of the private equity world I'd say is largely very different from public markets, where you have to do, you're on a board and you're doing due diligence. It's like very deep accounting due diligence, or, a much more operating expertise are required. Whereas when you're participating in liquid capital markets, it's a lot more of like analysis heavy, searching for alpha with more quantitative type strategies
and structuring things. Yeah.
in structure. Yeah,
Structuring
exactly.
investments,
So yeah, the world that I came from was we were a buyout private equity fund. You have like this range of, from I kind of view the world from the position of control. You can take minority interests to you can take controlling positions. Once you're taking controlling positions in companies, that's a whole new can of worms. There's a lot more that comes with that. And you have board seats. You are bringing in a new capital structure when you're buying out a company. You have to have lending relationships sorted for all of that, the amount of due diligence that requires, and the insurance, and like all these other things get really nasty. So like the world that I came from, we were buying out corporate carve-outs from larger enterprises. And these were like declining units of a business. There's no natural buyers for that. So you have to be a specialized buyer and say, like, we're going to buy this piece of a pie. It doesn't have a back office. The accounting gets really nasty because when you're looking at a piece of a pie, like corporate overhead's doing all these allocations. And it's just like, well, what is the cash flow of this actual division? And that's where all the negotiation comes down to. And so like it's just what we were doing was a little bit of like turning around a business that was declining and nobody else really wants to buy it. And we get really good valuations on it. And then if we can change something about the business and we can bring in, the right capital structure for it, then we can make, pretty strong returns doing that.
So think about that mentality, right? The mentality of where the world we came from. It's very focused on, structuring trades, finding inefficiencies, taking control positions, using a lot of financial instruments to maximize your profitability. It's financial engineering in essence, and my side, a lot of arbitrage, a lot of pairs trading and hedging out risks and isolating the alpha that you're trying to capture. Now imagine being from that world, and then Bitcoin comes onto your plate, and you're like, well, there's no cash flows. There's no underlying value. This is what they see, right? And it's like, I can't really attach anything to it. It really mostly just looks like high flying tech stock. It looks like a really risky technology play. And yeah, maybe I'll throw a few percent at it here and there, but that's the only people who were doing that really by and far were hedge funds. They're taking flyers on it, just saying, this is like an NVIDIA or an Amazon. I'm just gonna take a flyer on it. But they don't really understand it. And they put it in the same categories, ETH and Solana and whatever else they can find. They think, oh, well, they just have a higher volatility. They have a higher beta to that base asset, which is Bitcoin. How can I trade around it? And that's where they're coming from. That's like kind of the starting point in the hedge fund world. You go to the private equity world, you go to the pension funds, the institutional investors, the real big money. We're talking about, the biggest hedge fund I was in was about $5 billion when I left. I don't know how big your private equity unit is, but $1 billion in private equity is a big deal.
We were like middle market around like 350, 500 million.
Yeah. So, but we're talking about institutions that have trillions of dollars, like hundreds of billions of dollars of assets, like hundreds of billions that they're sitting on. You're talking about California pension retirement, you're CalPERS, you're talking about Texas teachers, Guggenheim. Like these are massive, massive behemoths, and they have all this structure. So this kind of sets a stage to, okay, you've got this Bitcoin thing. It's been around for all these years, right? And people have heard about it. But really the only ones who have dabbled in it are who I'm talking about. And maybe some of the private equity guys in their own personal account, but not in their fund. And in the hedge fund side, it's just a risky asset, right? So that kind of is where the mentality comes from. The thing is, if you're going to own it as one of the big institutions, if you're a registered investment advisor and you have clients that you're managing. Okay, so here there are different categories. You got private equity, you've got hedge funds, you've got the pension funds, you've got you've got the endowments for schools. But those have, like, when you get to that level, the structure there is like they have hierarchy structures. And so it starts with the highest person up in the investment side is the chief investment officer. And then you've got portfolio managers, and then you've got analysts, and some of them have in-house traders. And so, and all of those people are involved in this knowledge, gathering and synthesizing and making a decision out of. So if you just think about what they're doing is they have specialized funds. So people think, okay, well, Texas teachers, well, they've got to own X amount of bonds, X amount of stocks, X amount of foreign stocks. But in reality, there are different portfolios within there, and they have them segregated into buckets.
Are there certain buckets they're mandated to hold or mandated that they can't hold?
Yes.
Yeah.
Go ahead. Yeah.
Yeah. It's like, to his point, like it's a very corporate structure, and there's a lot that the mandate can, in terms of like the hierarchical structuring of it. And like, I think a lot of people are just like, oh, if you can just, why can't they get this, and why can't they understand Bitcoin? It's like, well, it's just like getting anything done in like a hierarchical corporate type structure. It's like you can sell people, but you're not necessarily incentivized to be a cowboy or be a first mover in one of these businesses. So
you're actually disincentivized.
You're disincentivized. Yeah. You don't want to be the first mover. So it has to like kind of come in this bottom up way. And you could have a portfolio manager in one of these structures be totally sold, and he could have a fund that like the mandate allows for it. But why would he take on that risk and be the first mover? And that's a whole different argument.
Even if he does, let's say he's like, okay, I really believe in this, and I think I can generate alpha because I'm a young portfolio manager. I'm in this fund that has $1 billion. I want to go manage a fund with a $10 billion, right? So I want to make my name. And the way I can do that, like, look, David Swenson over at Yale made his name by doing these things. He was the head of the Yale Endowment when I was there, and he went way out there. He was buying private equity, he was buying venture capital, he was buying hedge funds, and all the other endowments were like, is Yale out of their mind? And then their returns started, they started having better risk-adjusted returns, and all the other endowments started to catch on. So he was young, and he was making a name for himself, and he was doing very well. He wasn't trying to skip to a different endowment. He was just he believed that this was the right way to go. But let's say you do have you have a portfolio manager in one of these big funds, in one of these, big institutions that decides, I want to do this. Well, what do they have to do? They've got to get everybody up above them to agree to it. They got to get, like, if you're a portfolio manager that happens to answer directly to the chief investment officer, great, it's only one layer, but you've got to get their buy-in. Then they've got to get the general counsel's buy-in. The general counsel has to get all the compliance committees buy-in. Like, it's this, and I've talked about this before, it is such a long and arduous road to get approval to do something like this that's a new asset class that is very, it's nascent, it's not defined very well in the Wall Street world. The SEC has just reluctantly allowed these ETFs to come. They've kind of warned people against it, though, at the same time. It's like, there again, you go back to, well, what's the incentive for the chief investment officer to say yes?
So is this why when, is it Abby at Fidelity? Is that her name?
Yeah.
And Larry, like when Larry Fink gets it, then it just kind of goes downstream from there.
Well, yeah, because then everybody's like, okay, well, wait a minute. Now this is a whole different conversation, because Larry Fink gets it because he knows he can make fees off of it.
Yeah.
Like he may believe in it, but it doesn't really matter. What he believes in is other people believe in it, and I can make fees off of that. That's his job.
Yeah.
Nothing against that. That's what his job is, to create a product that people want to buy.
Yeah, exactly. It's like it's more of a question of like, because so it's funny because people mix up Blackstone and BlackRock all the time, and they're like kind of at like two ends of the spectrum of the financial, the investment management industry, where like Blackstone is the largest private equity fund in the world, and BlackRock is the largest asset manager in the world. Completely different strategies. BlackRock is high volume, low fees, whereas private equity is much more targeted, high fees. And so BlackRock's making a bet that there's going to be a lot of volume in this, and that people are going to be transacting in and out of it. The assets under management are going to grow over time. In terms of, if you were to make a calculated bet on this industry as like a private equity or hedge fund type, or as a long-term time horizon approach, it's completely different as to how they'd be considering this versus BlackRock. So like going back to the pension fund argument, when these guys are considering an allocation to this, it's like, well, how is this going to be building out much more long term as opposed to we don't really want to take a major stake in it. We just want to know that people are going to have interest in it.
And the first thing is, where's it going to go? Because we have these buckets. Like, what bucket does it go in?
Yeah.
So when you're a hedge fund, you're trying to get an allocation from one of these pension funds, these endowments. What they want to know is, what bucket do you fit in? So my Bitcoin Opportunity Fund, they would be like, okay, you fit in the Bitcoin bucket. Problem is, we don't have a Bitcoin bucket. You know, it would be very difficult at this point. Maybe in 5 years, maybe in 3 years, but it's just.
Crypto buckets becoming a thing?
Yes, they are.
Yeah.
Yes.
Yeah.
Yes.
Yeah.
So maybe we fit in
that's like one of the fundamental problems, because that's the exact mistake that I made when I first heard about Bitcoin. Is it wasn't pitched to me as Bitcoin really. It was just like, look into blockchain tech. And I looked into it, and you apply this financial framework of, well, okay, so it's this new technology. It doesn't really have any cash flows. You can kind of like look at deriving fees of the network, but there's no way that you can have, if you were to actually structure a vehicle of certainty around this, you can't really extract any of that out of it. So it's just like, okay, well, this isn't comparable to like a security framework. And it's like, okay, well, how do I produce any sort of valuation? It actually could be a technology that's worth a lot, but I don't know what price point makes sense to me to get in at, and I don't know what price point makes sense to me to exit it at. So that's what made me avoid it for years. So I was just like, speculative investment with no fundamental value. That's all within the framework of assets, not like monetary good, which is basically like the other side of it. Where once I understood the problem with central banking, at a very nihilistic view of what the future was going to be like. I was just like, okay, well, it's going to roll into another empire at some point, and we're going to have a collapse, and it's going to follow the same pattern. But once I realized, okay, how is this all going to end? And it's Bitcoin is this emerging monetary good. It's an alternative system to central banking. That's when everything completely changed for me, and that's when I was just like, okay, cool, I got to look into this. And then you get led into the crypto rabbit hole for a bit, and you're just like, okay, well, how are these other, technologies better monetary goods? And it takes time to really get to the point where just like, Bitcoin has these unique properties that can't be replicated. And we basically have this we have an investment opportunity that hasn't emerged in effectively in millennia, if you compare it to like a commodity as a base layer asset. And nobody understands it because there's no financial framework to apply to it.
Hold on a second. Why can't it go in the commodity bucket? Because commodities don't have cash flow.
It's a good question. I think it could.
It can.
Yeah.
It can, but it's just, you've got to get past what I said before, which is that initial just knee jerk of, this is just a technology, high flying, like this isn't gold. Like this thing is all over the place. I can't put it in the same portfolio as my gold and silver. Like it doesn't make any sense, right? So of course we all understand it at a different level. But going back to what you're saying is like that's a long putt to get there. You were interested in it. You wanted to find a way for it to work for you and understand it intellectually as a place to invest, as something to invest in. And again, you hear that word investment, because when you're in Wall Street, that's everything you're thinking about is rate of return. Like, what's my risk reward? And we can get into all of that in a bit, but that's all you're thinking about. Where do I put it in my bucket? How is it going to affect the volatility of my bucket? How is it going to affect the returns of my bucket? That's all you're thinking about, because that's what you're paid to do, is maximize your risk-adjusted return.
And if they're considering it like a high-flying tech stock, they're probably also considering that the price maybe dumps and never returns, or even goes to zero.
Correct.
It could just completely fail.
That's right, because they don't understand it. They don't understand the decentralization. They don't understand how it's grown and how the organic nature of it. They don't understand the user base growing. They don't understand the second layer benefits of it. It takes. Well, I mean, I don't know. It took me a good 100 hours of research to just feel like I started to really begin to understand it. I don't know about you guys, but yeah.
I mean, I would say even in doing this podcast and speaking to hundreds of people, it certainly wasn't at the start of doing the podcast because we covered shitcoins. I would say only probably about 3 years in, a lot of it clicked in a way where I was like, this isn't going away, and it is going up forever.
It took me getting wrecked in shitcoins to understand it.
Okay,
Yeah,
and I've
there's
heard
that
that.
too.
Yeah,
Yeah.
and you asked a great question of Hoffa. The other day, I was watching that interview with him that you did the other day, and great interview. But you asked him, do you feel like it was easier to understand Bitcoin coming from the traditional finance world because you had all this financial training and you understand all this stuff? And as soon as you asked that question, I was like, oh hell no, it was way harder
Makes it worse.
because
You have to reframe.
You have to unlearn everything.
Yeah.
your brain is already solidified. It's like
Mm.
calcified in this fiat world, and how to
Yeah.
how do you value this? How does it fit? How does it you have to unwind all of that. And
Whereas I've never done any investing in my life. Like Bitcoin's
Yep.
the only real investment I've done, apart from literally fucking around with some CFDs once.
Mm-hmm.
Like I've done no real investing. I don't have that baggage, I guess.
it's baggage, yeah.
Yeah. And to the point about how much time, well, I guess one other point I want to make too, before I forget, on the commodity bucket piece, I think the biggest thing too that they're looking for is when is this going to have a negative beta? And once it has a negative beta, then they might be like, okay, this falls into our commodity bucket, because that's really what they're searching for.
Explain what a negative beta is.
Yeah.
Yeah, so like if it just means that it has an inverse relationship with other asset categories is really how you're looking at it. So like when the market moves, the broader market index, that can be chosen in a variety of different ways. When that moves up, if something else moves down or vice versa, that's why people look for gold. The correlation that gold has to other assets is that, risk happens fast. You want to have exposure within a portfolio so that if, broader asset correlations all start going down at the same time, you maintain optionality and you have value in an asset that's going up at that precise point. So that was one of the big criticisms of Bitcoin for a while. And it seems like, and I haven't looked at the data on this recently, but I remember it was at like the beginning of last year that Bitcoin's correlation with broader market assets is starting to detract from its historical pattern. And I think that that's going to be one of the most massive aspects of this is once we have these passive buyers coming in with the ETF, it's going to change the narrative because now it's going to start to behave in a very different way with its price action. And once that happens, once it can kind of fall into a commodity bucket, because we do start to get this inverse correlation of Bitcoin with the market, people are going to categorize this asset so much more differently. It's going to open up the floodgates for more like strategic asset allocation.
Totally agree. But one of the things that Bitcoin has going for it and against it in that sense is that it trades 24/7. And so if you're in a situation, you're a portfolio manager and you own some Bitcoin, and you actually own the Bitcoin, not the ETF, and you're like, or maybe you do own the ETF and you just want to hedge out, you can trade this thing over the weekend. So let's say that there's an event that happens Friday night, Saturday morning, Saturday afternoon, Sunday. You can say, oh, I want to take some risk off my portfolio immediately now. Well, everything's closed except Bitcoin. So that's going to kind of work against it a little bit when we have these, these uncertain periods, or it could, especially. We have the saying in Wall Street, it's like not in private equity as much as in hedge funds. It's like I don't want to be exposed over a long weekend. Like if I have something I'm supposed to be hedged on, and I'm not hedged, and I'm going into a long weekend, I don't feel good.
Why doesn't that work both ways though? If they want to add risk over the weekend,
They can, but it's when it's more along the lines of when you have an event, right? And it doesn't even have to be a black swan. It just has to be an event that's a negative event. That if it's big enough, then typically all assets correlate to one, right? And that means that they all draw down at the same time, even gold. Why is that? Well, because portfolio managers look at their exposure and like, well, I'm going to get margin calls on these things because they're all operating in at least Reg T, and so which means that they're borrowing half of their portfolio, and so they know they're going to have margin calls on certain names, and they're like, okay, I've got to raise cash. Where can I raise cash? Well, the easiest thing to do is just sell 10% across the board. Just sell 10% of everything I own, and we're going to figure out what's going on because this market is nuts. I don't have time to get in there and figure it out. If you don't have it modeled out beforehand, that's what happens.
I'll tell you a little story about my failed attempt to trade stocks. So back in 2012, where I was just in my fiat job, had my agency, and I was fucking around with these CFDs, right? It was a way I could just bet on the stock market, and I didn't know what the hell I was doing. I was playing with luck. But what I noticed is nothing went up in a straight line. It would go up and then it would go down, it would go up and then it would go down, but like directionally in one way or the other. And so I was just kind of like playing that with Tesla stock. And I was doing well. I was like trading all, and I got up to like the close. And when we hit the close, I was closed out with my short. I hadn't closed out my position, I was in a short. And I remember it specifically because I was on a train and had my phone and didn't have a good connection. And so I didn't close up my position, didn't think anything of it, right? Anyway, going over the weekend, and this is where I discovered pre-market, right? And the pre-market, they were up like 20%. And the problem is CFDs, they're leveraged, right?
Yeah.
And I think it's because they'd had like some kind of like announcement about sales, whatever. There was a lot of Tesla stuff going on back then, 2012, 2013. And I ended up with a position. I remember it specifically because I was £4,000 down. That was a huge amount of money for me at that time. Like that's that's what I live on for 2 months, right? And so I had to call my ex-wife and say, "Look, I'm feeling shit. I've got a confession," and told her, and I never traded again after that. I was done. I was like, I just don't know this.
Yeah.
Well, if you don't know it, you might as well go down to the casino.
Yeah.
Yeah. I mean, honestly.
I know that was my exposure, but that.
Yeah.
And so when you mentioned the long weekend, I was
Yeah,
like,
that's
shit.
I thought this was going to be
PTSD.
the other trading story.
Which one's that?
There's another
From
Oh,
in LA.
the other.
Which one was that?
In LA, when you turned up to the job interview in flip flops.
No.
Have you ever told that story?
I don't know.
Do you want to start a story?
I don't mind telling it. It was when I first got into Bitcoin. I was flying back and forth to LA. You met my buddy Justin the other night.
Yeah.
Yeah, so after I got divorced, he used to like just come out and stay with me, and I did. So I used to come back and forth. First got into Bitcoin, I was just tweeting about it. Probably had like 1,000 followers or 1,500 followers. And I was on the plane just tweeting, I'm off to LA. Mike Jones, who runs Science in Santa Monica, he was the CEO of MySpace when that was taken over by Rupert Murdoch.
Cool.
So cool guy. He's like, I'm interested in this Bitcoin thing. Might have a job for you. Do you want to come and see me? I wasn't working at the time. So, and it was really humid. And I got to Justin, I was like, I haven't got any clothes for this. Like, can you lend me some clothes? And it's like, what would you want to wear? I was like, I don't know. He's like, do you know what, Pete? Just go in shorts and flip-flops. Just go in shorts and flip-flops. Bitcoin's this new thing.
SBF'd him.
Yeah, if you walk in
Yeah.
shorts and flip-flops, you're going to crush it. I was like,
You're a
I can't
genius.
fucking do that. Anyway, so I did. I went in shorts and flip-flops, tats out and everything, just bowled into his office. He's like, tell me about Bitcoin. I didn't know shit about it. I just talked about it anyway. And then they turned around and said, great. How's your trading going? And I was like, brilliant. I showed him, because that was the bull market, 2017. I'd turned like 35 grand into like $1 million. And I had all my trades up on my website. So he was like, would you want to trade for us? I was like, yeah, sure. So they gave me 100 Bitcoin to trade, right? But it was right at the peak.
Oh.
And so everything, all
That's
the
awesome.
guessing that worked all through the bull market, where I thought it was
It
a
was the
genius.
exact opposite.
Yeah, it's the exact opposite. There was me, there was another guy doing it. And I think by the end, there was like 40 Bitcoin. They're like, yeah, we'll just close this out.
Okay.
I mean, look, that was 100 Bitcoin at a time when it was like, well, maybe it wouldn't have been 100. I can't remember the exact numbers. But anyway, I lost them a bunch of money, but they were pretty cool about it.
That's crazy.
That's
Yeah.
funny.
So yeah, every time I've attempted to be an investor or trader, I've completely failed. Like a fucking idiot.
There's a lot of investors and traders who fail on Wall Street too.
Yeah. So do you think the thing is they're not getting that Bitcoin is so much more than an investment? It's like a fundamental change in the world.
Well, definitely not. Yeah, I feel like, but I don't think you start there. You don't start it. It's a savings technology. I think you start with, well, one, the advice whenever people are like, how do you pitch to these people? I'm like, the first thing I try to do is I try to get their opinion, and I try to hear what they have to think about it. And like, I mean, honestly, like play a little dumb, and usually a lot more comes out. And I'm like, okay, here's their, and you get the perspective pretty quickly, and then I'll jump in with that. But usually it's kind of like what we were talking about last night. You can't make this whole like, okay, well, you need to understand money, and then you jump in and start talking about like, here's how money works. That's too much. You need to be like really quick. And what I find that works really well is what these guys understand. Very what's the word I'm looking for? Tangible points that are, highly defensible. And you can say like, Bitcoin is, de facto one of the largest computing networks in the world. It's growing on pace with the internet. The largest asset manager in the world is an investor. And then you can drop names that they're familiar with. Paul Tudor Jones, Stanley Druckenmiller, like things like that. And then all of a sudden they're like, okay, like why am I not interested in something like this? And why haven't I, dove deeper in that? That I think opens them up to start listening to the money argument.
Right. And then you get into, okay, so let's go back to the institutional, if you're an institution and your portfolio manager wants to buy it, right? But the problem with it is just structurally you literally could not buy it, because what portfolio manager in their right mind who's managing, $1 billion or $10 billion and has what portfolio manager wants to take control of 10 million or $100 million worth of Bitcoin keys? Like there's the personal risk is so high. Like
But why couldn't they go to like a Fidelity even before the ETFs?
they could, but they'd have to open up. It would be a whole new thing. Open up a whole new prime brokerage account with them, and have to go through all of those steps and make sure that they understand on the compliance side exactly how these keys are being held and how they're being managed and who's got one. Is there multi-sig, whatever it is. At the same time that you've got FTX going on and Celsius going on. And like, it's like that all was happening when I started hearing institutions circling around saying, this is something we need to start paying attention to. And then the fallout from all of the fraud. And, that was a massive blow. Okay. So now but there were so many things, Danny. It wasn't just like, how do you hold the keys? It's like, well, who's going to trade it? Is it an approved exchange? Can we trust that exchange? Is it not being manipulated? What are the fees going to be on it? Well, who's going to settle it? Who's going to prime broker it? Who's going to custody it? Where are we going to market? Do we market at New York close? Do we market at the 4 p.m.? Like what are we marketing at London? Like where is it marked? Market midnight? Like how do you do that? And then is it marginable? And obviously not. Like how do you like? And then you've got all those questions. And in one fell swoop, this January, they were all solved. Every single one of them. And there are still plenty of money managers and brokerages who are not on board yet. So we can come to that because most of them are not. However, the structural issues are solved. All they have to do is buy the ETF, settle it with their prime broker, have it custodied by them, and they know exactly how to trade it. They know exactly where it's being custodied, how it's being held, what exchange is being traded on, who's trading it. They know all of those things now, and they have it settled just like a regular stock. There's no difference to them. So it's simple. The only thing is it's probably not marginable like some of the others, but that's not atypical of, microcap stocks or...
What's marginable mean?
When you are managing the cash of your portfolio, you'll buy something and on New York Stock Exchange it's called Reg T, and you'll be able to borrow 50% against it.
Oh, okay.
So you'll have cash, you'll have excess cash that you can kind of manage around. If you have certain margin agreements, will get you down to somewhere around 10% that you have. It's called the haircut. But anyways, the long and short of it is that's all been solved. Now the question is, and I was over exuberant. I thought that there was a lot more institutions. This will get to your first question that we haven't really answered yet. Where are the institutions? And are they? They're not there yet. They're kind of still. Some of them are still kind of laughing at it. And why? Because of the volatility, it's gone up to 75, it's down to 60. It's like, where's this thing? Like, I can't keep, you guys are nuts. This thing is not, I don't even, again, know how to value it. What's the cash flow? Is it gold? Like, what's the mining? Like, I don't understand the mining. It's just math. It's an algorithm. Like, but.
Is there nothing else that's ever had this kind of volatility?
That's a good question. Long-term volatility in a rising asset, I don't think so.
Well, yeah, because part of this too that's nascent and also from the perspective of these guys with broader crypto is like we have these assets that are publicly trading that are early stage for the first time. And typically when you're dealing with any sort of assets, like the most volatile you're getting is like penny stocks. But like, we probably wouldn't categorize these things as like, like legitimate asset categories. But there's so like, I think that's one of the big things. I mean, I'm sure that you could back test like, I don't know, what is like one specific asset, but not like categorically. And you would definitely find some things.
And why is it so volatile? Is it a liquidity issue? Because it seems fairly liquid now.
I mean, James has.
Yeah, I mean, there are only so many exchanges you're trading it on, right? And it's volatile because there's pockets of illiquidity. So if somebody comes in and wants to buy 100 coins, that'll move the market. Typically, like if you see when you see these big wicks, it's when 5,000, 10,000 coins are moving in 15 minutes or an hour.
Do you see one exchange wick down to like 3K?
I think BitMEX went to 8 or something, but that was on like a one of their like perpetual swap contracts or
okay.
something.
Hmm.
I don't know. I don't understand why that happened.
A lot of it's that, like the leverage in the system is pretty immature. And,
Right.
Yeah.
That's right. And so exactly. Leverage in the system is immature, and then you've got levered traders, and you've got hedge funds who are whipping these things around. They're looking at those the books, and they're seeing what the perpetual rates are, and whether there's a lot of leverage in there, and then they'll sweep it out, and they'll just.
Do you know? I've got a question about that. So we often see when the price wicks down or wicks up, they say, "Oh, the market makers are just like sweeping out the leverage."
Mm-hmm.
What is actually happening there? Who is doing this, and why, and how?
Well, so what is happening is you can see when the leverage, when the interest rate goes high, that means that people are borrowing to do whatever trade it is, and typically, it's either they're going very long or they're going very short, and so you can see in there the kind of the balance on the books, and so a hedge fund will just they can come in with hundreds of millions of dollars and just push it through a price that they know will liquidate those levered trades. And when that happens, you get stopped out, right? So think of it this way. Let's say you've got a 10-to-1 trade on, or 20-to-1, okay?
Yeah.
21 trade on. So you've bought $5,000 of Bitcoin. You've given $5,000 to the exchange, and they have allowed you to buy $100,000 of Bitcoin, right? 20-to-1. The problem is if it moves by 5%, your $5,000 is gone. And so what an algorithm will kick in, and the exchange will just sell you out. You're stopped out, so they get their $95,000 back, and they don't lose that. So you're taking on that risk. And so hedge funds can see that those are where the stops are, or big whales. It doesn't have to be a hedge fund, but typically somebody with a lot of capital, and they'll stop them out. They'll know they'll get sold at the market, and then that's when you see those big wicks down.
But why would the whale, or I can understand why the exchange wants to stop them out, because
why would the whale do it? Because then the whale is going to sit there with bids below the market,
right?
And like one liquidation like cascade into another and another, and then you get a wick down, they'll have a buy further down.
Exactly. So that's what. So we actually saw that happen in big world. You saw that happen in London when the gilt when the gilt trade got upside down.
Big up to Theresa May.
Is exactly what happened in big terms, right? So the pension funds out there, right? They had these liabilities. And so they knew that with no interest rates for so many years, they put on these things called leveraged debt instruments, right? So what they were doing is they were levering up their debt to get, instead of 2%, they were trying to get like 6%, 3x, or maybe more, 8%, 4x, 10. They're trying to juice the returns, and actually was the actual interest rate was much lower because we were in ZIRP, zero interest rate environment, for so long. But they have these liabilities. They know that they're going to have to pay out pensioners as they retire, and they need a certain amount of capital. They've got to make returns to keep up, and so they were levered up. And then when you had your new Treasury minister or whatever came out and said, we're going to have big tax cuts, I don't know how we're going to pay for them, the market freaked out. They're like, wait. That means you're going to have to float more bonds. That means we're going to have higher deficits. And like, oh God. And we just, the UK had just crossed 100% debt to GDP, and the gilt market fell apart. What happened? Well, one of the pension funds got stopped out, and they got sold out. And to Danny's point, and then it triggered another's, and then another's, and they went into basically went to BOE and said, you got to rescue us, or we're going to be insolvent this afternoon.
And wasn't it like 50, 60 billion or something ridiculous?
It was a crazy number.
Yeah.
Crazy. So on a large scale, that's what happened there. And so the BOE came in and saved them. And Bitcoin, nobody's coming in to save you. If you get stopped out, good luck.
Do you have an expectation that the volatility will decrease as the market matures then?
Absolutely.
Yeah, I certainly do. There's so many different dynamics, and as these, I think that these passive flows, to what we were hitting on earlier, is going to change quite a bit of it.
Yeah. So on to that, I was surprised that not more brokerage houses and institutions were ready for those ETFs. But then if you go back and you think through it, Gensler was so against them. He was talking out against him. He was refusing. And then they were just asking questions. And you kind of had this sense that maybe it's really going to happen. And then you have the false tweet, the hacked tweet, supposedly. The intern put out the approval and then they yanked it back. And then they put out the approval in a press release and then took that down. And it was just a cluster, So if you're institutions and you're watching this, just circus, you're like, all right, let's just wait and see what happens. Let's see how these things trade. Let's see, because this is just a zoo. And so they all waited. And so, and now we're at the point, and I was surprised. I thought that a lot more would kind of come in right away. They didn't.
You were surprised that the volume of the inflows?
I thought it'd be more.
Oh, really?
I thought there would be more brokerages that would be approved to do it. Now we have Vanguard, who's just absolutely refused. They're not going to. They'll capitulate at some point, but they're not going to do it for the time being. But then you've got, I expected for these brokerages to see that this is a great thing to offer to. Fidelity's doing it. Well, Fidelity's got their crypto asset arm, and so it was easy. They've been holding Bitcoin. They know how they have one of the ETFs, so of course they're going to say yes. But then things like when you see Morgan Stanley or Goldman Sachs, and they just absolutely refuse. They're like, well, if you're a private client, meaning if you have $50 or $100 million with us, and you ask, maybe we'll accommodate you and you can buy the ETF. But they're not actively out there, offering it to any of their investors.
It's all just inbound.
It's all inbound. That's right.
So what's the role of Morgan Stanley and Goldman Sachs in this ETF interest?
So they manage money for people.
Okay.
Right. And so
like BlackRock.
Somewhat similar, but BlackRock manages funds.
Yeah,
so it's a little bit different. But
okay.
These guys are behemoth financial institutions. They have divisions that are probably touching in all different areas of financial services, but Goldman's historically an investment banking type.
Okay.
The majority of their revenue is coming out of that. But then they'll have their brokerage house that's, managing
high net worth, super high net worth.
Yeah.
But if Goldman went balls deep like Larry, would you expect huge inflows at that point?
Well, I would expect significant,
yeah.
But it would be more that, Goldman's doing it. Okay. Goldman's doing it, I'm Morgan Stanley, I'm going to do it. JP Morgan's like, well, if Morgan Stanley doing it and Goldman's doing it, I'm going to do it. Citigroup is like, well, maybe we can offer it to our people. But the thing is, you've got to get all of it wrapped up. And there's a 60 to 90 day, it's like a 60 to 90 day kind of quiet period when something like this is released, where they're watching it, they're kind of circling their ducks, they're having their meetings, they're having compliance meetings, and then more compliance meetings, then more compliance meetings, and then you've got the general counsel, and then more compliance meetings. The compliance meetings are mind-numbing how many that you're going to have on this. And then they're going to have the pamphlet. And they're going to have the copy written for the pamphlet. And then it's going to go back to compliance. And the general counsel is going to look at it. And it's going to go back to compliance. Because we need to change this word because we got to CYA, cover our ass. We don't want to seem like we're pushing this, It's
so funny. Do you know what's so funny about that is they're having to do all of that while we're all out there memeing and being DJs, hanging out in Vegas.
Have fun staying poor.
Being irresponsibly long, trolling them.
Well, this is the craziest thing is what I've been talking, and you and I talked about this last year, is we can, for the first time in the history of Wall Street, we can be front running the institutions and buying this thing, and they still can't do it. Their hands are tied. They just can't do it. And even and I'm talking about pensions and endowments, the big ones. You're seeing a trickle of the private clients coming in. You're seeing the trickle, and that'll. So you've got this super highway that's built. They can do it. It's easy. They got to build the on ramps, and each institution has its on ramp. But for the first time, it's back in 2000. Well, you're younger, but back in 2000, we were, and I've told the story before, but we were ecstatic if we could get an allocation to one of the hot new, IPOs for the internet, for all these new hot companies. If you were going to get 1,000 shares of pets.com, or you're going to get 1,000 shares of Amazon, it was wow, that was going to, because you knew the function of it. The investment bank prices the deal. They syndicate it, and then they farm it out to their best clients. So I get 1,000 shares of that because I'm one of the best clients. I'm at a big $5 billion hedge fund. And so, but they price it at $20, say, okay? That's what the deal price is. When it starts trading that morning, I got my 1,000 shares, it's hit my account, I'm all happy, and it starts trading. It doesn't trade at $20. It trades at like $70. And then it trades from 70 all the way up to like 120. And who's buying it there? Well, all the retail buyers bought it at 70 on the opening, and they bought it all the way up to 120 while I'm sitting there with my $20 price. I'm happy because I got it first. That's the exact thing that is going on here. You could have been buying this thing, you know, back at $16, $18, $20,000 when all these ETFs were being they were all filed and they were all fighting for it. And then Grayscale wins their court battle, and you're like, this is going to happen.
Yeah,
You could be out there buying this thing, and now it's trading at 60, 70. It might go back down to 50. Who knows? It's Bitcoin, but this is not stopping. When the institutions when more and more on-ramps come on and more people start to understand it, there's going to be more capital, less volatility, more capital, but it will just continue to gravitate upwards. And we can talk about the function of how institutions buy it, because in reality, if you're an institution and you have let's say you have a $1 billion hedge fund and you want a 1% allocation, that's $10 million, right? So you're going to turn around, you're going to go, hey, I need to buy $10 million worth of this. You're not going to tell them, buy it at $62,300. That's your limit. You're going to say, I need, $10 million worth, just go get it. And they'll go out and buy it. And then when they get that, I want to buy another 10. Just go along with the market. But that's one institution. When you have 20 institutions doing the same thing, now you've got $100 million at the market. They're all in there participating during the day. Well, there's going to be a day where you have not just $100 billion. You're going to have like billions of dollars that are kind of at the market, all climbing over each other, because you've got some of these big boys that have gotten approved, just the timing worked out, and now they're all out there buying it. They're not that price sensitive. They just want to participate and get a share of what's been trading. And so it's just a different mentality,
Do you think a lot of them will be looking at their exit prices? So, you say you got pets.com at $20. If it's at 120, you're like, I should sell this, or do you carry on? Like, will because I remember there was that company in the last bull market. It was the gold investment firm.
Ruffers?
Ruffers. Yeah. And they double their money and then they sold out.
They did pretty well. I think they 3x'd it.
Yeah, 3x their money and they're like, we're out.
Nobody still owns Amazon from the IPO.
Yes.
Except for Jeff Bezos, right? And his family, I think.
And his ex-wife.
Right. So that's it, right? So if you're an institution, you bought this thing when Bitcoin was down in the 40s, when it gets up to 100, that's a major mental level. They will be filing out. In fact, I expect they've been trading around it up here at the all-time high. They're like, once it hits all-time high, we'll get out and then let it shake out. We'll buy it back, and then they'll ride it to 100. So
because the interesting thing about Bitcoin is the longer I've been in it, the more I've realized never sell, right? And I used to sell a bit here or there, and every Bitcoin I've sold, I've eventually regretted. And once we have mature markets for borrowing against it, because I think we've got semi-mature markets, like what Unchained have done with their segregated custody is interesting. Yeah. I think Ledden have a similar one. It's kind of interesting, right?
Look at
but
this.
Really,
the largest lazy Susan ever.
But what I want is I want Fidelity to be doing it.
Well,
but if we get to that point, I'm like, I'm never selling. So, for example, with my football club, right?
Yeah.
If we raise money.
When we raise money,
there you go. I'm going to put it all in Bitcoin. And then I know if I sit on my hands, that's going to give us more power as a football club. If I raise the right amount of money and manage it in the right way, we may never need to raise again.
Right.
And so I'm in that mindset now.
But you have a different mentality.
Yeah. But do you think they will get to the point where they realize we should never sell this?
Yes, and this is how they'll get to that point.
Or do they have to sell it?
This is how they'll get to that point. They're going to buy at 40. They're going to sell at 70. They're going to buy at 50. They're going to sell at 100. Then it's going to go to 300. And they're going to go, shit.
Yeah.
And then it'll come back down. and then they'll start buying it and just hold it. But it's going to take them a couple of cycles of and there will be they're going to be mental stop outs. $100,000 is going to be mental stop out. 200, 250, mental stop out. 500, definitely.
Big round numbers.
Big round numbers. It's just like your mind, it's natural for the human's mind to attach to that.
But if you're like a pension fund, you've got to pay out on those pensions. So you have to sell assets at some point, right?
At some point, yeah.
At some point. And so at some point, will they be required to sell the Bitcoin, or do you think it will be the last thing they sell eventually?
No, what they'll do is they'll rebalance.
Yeah.
Right.
They'll rebalance it. Yeah.
Are they guaranteed to rebalance?
Yeah.
Will they definitely do that?
Yeah, because they're going to have some sort of strategy, and if they're saying like whether it's a commodity allocation or whether they're saying like we're going to maintain a 1% position in Bitcoin, and then that's going to go to 300, and all of a sudden it's like a 5% position that they now have, and they're going to be like, okay, well, they're going to be selling and maintaining that position over time, and it's going to depend on a lot of factors. But at the end of the day, like there's going to be quite a bit of selling. But yeah, the key thing I think on more the hedge fund side of the world is like there's going to be a point where and this is what I tell everybody as well, just general retail. It's just like, sure, like, there's ways that you can try to time the market. There's ways that you can probably make money doing that. But we're going to hit, whether it's like super cycle theory or whatever you want to call it, we're going to hit a major inflection point. And Bitcoin's going to 10, 20x in a very rapid way. And once people, to your point, once people miss out on that, and the question is how big is that actually going to be? And we don't know, but like once most of the world is aligned in terms of infrastructure to be allocating capital directly into this asset, something could happen very fast where, Bitcoin gets into the millions of dollars in a very rapid way. And then all of a sudden it's just like how many people are going to ultimately end up missing out over that period.
Yeah,
and that's going to be material.
But so let's talk about that, right? So the multiplier effect, right? You don't need, $1 trillion to come into Bitcoin for it to double from here.
Right.
You just need $1 to come in or less. Someone buy one sat, one fraction of $1, and there's no offers between here and double the price. So if somebody buys, if there's no offers between here and $130,000, and one sat trades, that's the market value of Bitcoin now. And that's the hard thing to wrap your head around. So it has to do with the demand and just how much that demand is outstripping supply at any one moment, which goes back to your volatility.
And so you feel like we're very early then?
Very
early. And this is something that, I really want to get into this conversation because there's always like, okay, so one thing that annoys me on Twitter, for example, is when people are like, okay, well, we only have this much supply coming in and, there's this much earmarked in terms of demand. Here's some sort of ratio between these two variables. And it's like, at the end of the day, it's just like, sure, that's like, it's like, kind of like a finger test of like what could be happening. And there's a lot of ways that we can look at that. But at the end of the day, price is determined where marginal buyers meet marginal sellers. And to James's point, if marginal sellers has just become such a low number that there's practically no market on the selling side, it doesn't take that much buying power to really have this price to start shooting up. And that's like one of the primary arguments. But yeah, all we know in terms of like a lot of these prospective things is that there's a lot of heuristics, there's a lot of models we can look at, but to say with certainty is all we know is that demand is dynamic, supply is dynamic. When people are like hodlers are hodling, it's just like, well, yeah, I mean, but at what point are they not? And that's a reality.
Yeah, because who was it? There was somebody who maybe it was a Twitter post that, or I can't remember if it was a message to me, but somebody who knew somebody who was very early, bought it $100, had a few $1,000s worth or whatever, turned around, sold at the high for 48 million, is out, done. Okay, well that's going to happen,
Yeah,
and
that's part of the redistribution, though, right?
Yeah,
totally. We exactly. We want that. And that's. I think we had an episode where we talked about this, and it was just like, what's going to happen with wealth inequality intra Bitcoin, and it's just like it's true of any sort of economic system that we are naturally going to have people who are, some of the primary capital owners within that system start to reduce their allocation with that system. It only makes sense. They only have an incentive to do that over time. By hoarding significant proportions of the supply, it's actually undermining the value proposition. And as the incentive for them gets greater, that indifference curve that they have of buying and selling is going to change. But like even at a fundamental level, hodling is an incredibly important thing. It's what got Bitcoin to where it is. It's going to continue to get Bitcoin to where it is. But people need to eat and people need to live and people will do that. And that's good. But yeah, this whole debate, like whenever it gets into this or like the halving and like what's priced in and all this crap, it's just like all we can say is marginal sellers and marginal buyers. That's dynamic, and we can try to earmark different degrees.
And we know that demand is growing. I mean, yeah.
What I don't get about that, like someone who bought $100 got 48 million. Like I understand they want to take some off the table, buy an incredible house or whatever, like go on holiday.
But why take it all off?
But
right?
yeah, what are you doing with the rest of that money? Like, are you then going to sit in dollars? Like,
well, that's it. And yeah, I can't make that. I have no idea what they're thinking. And maybe they just said
ideas.
It. Yeah. You
yeah.
know.
There's a lot of things I'd be willing to buy if I had 48 million right now.
Yeah.
I mean, you could.
But, so would you sell all your Bitcoin for 48 million and then sit with no Bitcoin and just cash?
Nah, not really. I mean, I would just, there's going to come a point in time to where, you know, I'll definitely be selling a material proportion because I like to enjoy life. I like to live life. Like,
but taking it all off this table, just, it makes me think you don't understand what Bitcoin is.
Totally.
Sure.
Yeah. I would sell like kind of looking at it like savings. I'd sell like the appropriate amount to where there's going to be a point where I'd be like, okay, I want to make a big step up in lifestyle. You know, I want to get this nice house. I want to get a car that goes really, really fast because that's like part of the fun in life for me. And like, you know, there's going to be all these things that I would do. And, you know, and that's going to be fucking sick.
Lambo.
Yeah.
And so, you know, but to your point, Danny, there's a lot of tourists that are going to be in this. And we're seeing more tourists come in every day now through the ETFs. So what's happening? Well, when it jumps to 120, they're going to be filing out. And it's not like you're going to see those orders on the books, on the exchanges. They're going to be sitting there and you're at a hedge fund, you own, you know, 1 million shares of the IBIT. And they're like, oh, look, it just jumped to 93,000. You know, why don't you sell 500,000 here? And it was nowhere. It was nowhere to be found. It wasn't on the books. It wasn't in the order books. It was nothing. It's just suddenly, boom, shows up like that. And that's how we're in a market now that's so dynamic, you know, that you can have orders show up in nanoseconds. Yeah. I could literally look at a screen, pick up my phone, call my trader. It's already on the exchange within less than a minute, like probably 20 seconds, you know? And so it's different today, and which plays the volatility. And, you know, we saw it in GameStop, you know, and when you have huge bouts of volatility and big bets either way. And this asset, Bitcoin, is one thing we've seen is it does produce a lot of emotion around it, you know, so both ways.
Yeah,
know?
Which is good marketing.
Do you think some people at the moment are potentially risking reputational damage themselves, like Vanguard, or would they ride this out? Could it be a scenario where in a year they're like, fuck, and everyone's like, why didn't you allow us to have this?
Well, I think that Vanguard, and I want to hear what Eric has to say on this, but I think Vanguard has a different demographic that they're serving than, you know, certainly Robinhood, you know?
Yeah.
So they have, I think they got a lot of rope. They've got a lot of rope right now, but they're not going to win over young investors. And that's the problem, is that as this demographic ages, as the boomers die off and that wealth gets transferred to younger hands, they're going to take it out of Vanguard. Going to be like, the Vanguard doesn't understand me. That's my thought.
I definitely think there's truth in it, but I do wonder how much people would actually care. You know, like news cycles happen fast, and let's say Vanguard comes around in 3 to 4 years, and they're probably still going to have the same boomer clients, and then they're going to be moving forward with like a Bitcoin allocation. People are, you know, we'll see how quickly people and all the media are just like, yay, you know, once they're on our team, like who cares anymore? Okay, yeah, well, like some people might dunk on them for a little bit, but outside of that, it's basically just be like, okay, cool, they're on our team now. They're the second largest asset manager in the world.
$10 trillion.
$9
trillion of assets. I mean, they've got a lot of rope.
Yeah.
You know?
Yeah.
They need to get their social media person on board, because I've been impressed with Franklin Templeton, and Did you see the Van Eck one the other day?
Those were funny. Van Eck's doing it right. Like
you see the one
Franklin Templeton. Wait, which one?
The one the other day where somebody like Van Eck tweeted something. Somebody put "Okay Boomer" and the Van Eck Twitter account replied "Okay Renter." Killed me.
That's good. That's good.
Wow.
Yeah, they've been pretty good. I think they kind of get it. Like I've met their head of digital asset research, and I think that they're looking at things in a good way. But the Franklin Templeton. A lot of things I like. I was shitting on them for a little bit. I think that they're. I don't think that they totally get it.
So going back to your friends that have been in touch, you've got a mixer, some laughing. The ones who are coming in now, is it the same questions or are the questions getting better?
I think they're getting better from what I've seen. People are starting to get their head around some of the money side of it, is what I'm noticing. There's less people coming in. Like, granted, I still have people. I think people coming in from more the crypto angle. What's good and bad is that they're coming in asking me about Bitcoin L2s and like what's the best L2, and that's a whole other can of worms. What I like though is like some of my research is starting to get picked up by big crypto podcasts, and that's huge because now I can just like send these guys a link and just like, look, man, I think it's going to be very different from what a lot of people are talking about. Check out this link, which is like a 20-minute clip, some overly simplifying and being totally incorrect about it, but nonetheless is getting some of the message across, and that's, I think that changing within like the broader zeitgeist, that's going to be super valuable because now we're having a much more direct funnel, I think, towards Bitcoin and the money thesis. So I think it's coming in from different angles is kind of the answer.
Yeah, I'm still, so I have a few people who have contacted me from my old world, in the institutional investing world. And, they're asking about things like the mining stocks, MicroStrategy, like how, like, are they these good values in here or whatever. But then when they know that I have this Bitcoin opportunity fund, they're like, really? And it's just that, like, really? That sounds crazy, There's that silent, that sounds crazy at the end of the really question. And
James has lost it.
He's lost his mind.
Yeah.
And I don't care, because they're going to be, they're so far behind in this.
Yep.
And, but they can't get their heads around it.
Yeah. So like, which is, I guess I was answering a bit more from like the retail perspective, but yeah, from like the institutional type perspective and a lot of the conversations I'm having, it's definitely 4 years ago. There was definitely like the quiet type of answer, like, "Oh, okay," like trying to move on. Like, I'm not going to state my opinion, but I think you're a fucking idiot. And
I think Grant at 1031 had the same when he left. I think people were like, "What are you doing?"
Yeah.
Oh, totally. Yeah. I mean, when I left, like, I think, some people thought I was depressed. I think was one of the first things.
When did you leave?
This was 2020, end of 2020.
Okay.
Yeah.
Okay.
Like there were a lot of opinions, and I think that a lot of those have changed now just because, number go up. It's pretty much that simple. But I think that, I guess there's a distinction too between building a business that's like providing private capital to this. I think that that's something that is still like a long ways out for understanding. And then just buying Bitcoin itself. Like there's a lot more people that I think are understanding that. They're understanding the gold narrative. But when it comes to, okay, you're going to be an entrepreneur in this industry and build this out, like, why?
Can you talk about what you're doing?
Yeah. I mean, we're early stage, we're fundraising, but we're investing in Bitcoin companies and just like adjacent protocols, which is honestly, it's kind of hard to define, but it's freedom technology and using cryptography in ways that's innovating the financial system is like one of the best framings of how I think we're looking at it. But it just, the idea is that Bitcoin is, we understand the value proposition. We understand that as Bitcoin grows, it's becoming a much more valuable asset. It's becoming a valuable form of collateral, and all the infrastructure that's needed to bring it to the next step in its evolution is all getting built out today. And I feel like we're kind of getting to this inflection point in the ecosystem to where not only are people realizing the value proposition, but enough infrastructure has been built so that there's actually much stronger investable opportunities that are emerging on the private capital side. And the valuations are very different. Bitcoin is $1 trillion asset. And over this next cycle, we expect that to change materially and be even greater. So as Bitcoin increases, whatever the ultimate market potential ultimately becomes, um, there is an asymptotic relationship that's probably going to occur with return potential over time. Um, and then the question is like, okay, well, if we have infrastructure, which is almost like levered Bitcoin in some sort of way, that's valuations on the early stage side are in the 5 to 20 million range, the upside potential to invest in the next JP Morgans or the next Bloombergs or all this other infrastructure that's getting built out around it is really strong. And the question is, what is the timeline going to be for that? And that's kind of like the risk side that we're playing, I think.
Yeah. So, what is the investment thesis for investing in infrastructure, in kind of equity within Bitcoin companies versus just buying Bitcoin?
Well, I mean, you have to, everything has to be weighed against the risk reward of Bitcoin.
Yep.
And so every single investment is different, though. You know, a seed investment is different from a venture investment, is different from a private investment, is different from a public investment. Debt, equity, where you are in the capital structure, they all have a different level of risk attached to them just in the type of investment. And, you know, and then the company itself, like what kind of company is it? Are they super early stage? Do they have a path to revenue? What are their moats? Like there's so many ways you have to think about this, and each investment is entirely different. And so one of the great things you can do is, like Eric is talking about, is find investments where you're exposed to Bitcoin. So you're not handing them dollars, you're handing them Bitcoin, and then they're exposing you to their growth in Bitcoin terms.
Yeah.
So you retain that risk reward of Bitcoin. And we found a few investments like that in my fund where you're retaining that exposure to Bitcoin, but then you've got that levered aspect where you can do well beyond that because of the growth of this company will be a factor of what Bitcoin does. So those are the best kind of investments to find.
Yeah, like because what he's describing, it's like you have leverage, right? And then there's financial leverage that you can put into a business based on how they structure their capital structure, and there's also operating leverage. And like that's kind of the point, is that you're adding operating leverage into the equation, which is one way of looking at it, and that's powerful. But I think that there's a lot of frameworks for how you can say like there's also just you're getting exposure to the growth in Bitcoin. As well as but different characteristics of growth. Like you can be getting exposure to a business that either has its balance sheet or its revenue economics tied to the capital appreciation of Bitcoin, but it's also increasing its revenue based on the volume of transactions that are occurring, and that's just a different risk exposure that doesn't exist in other forms. So you can get exposure to other aspects, and you can make bets on like, okay, well, how is this particular aspect of the Bitcoin infrastructure going to build out over time? And like there's plenty of examples that exist in the industry of you could take like hardware, for example, and Ledger. Like a lot of these companies are nearly like unicorn status. They've achieved very high valuations in a short period of time. Exchanges have a persistent model that has localized characteristics that is defensible and can grow over time. And I think like a lot of the ways that you can make bets on this is like, what is the use case of Bitcoin going to be on what timeline? And it's like, okay, well, medium of exchange is kind of tough, but we do see, and that's much more further into the future. But on the store value side, there's kind of like this world of like, okay, well, Bitcoin's superior collateral. And there's a ton of valuable businesses that I think are going to be built around that, where we can use things like the Lightning Network to move collateral, circumvent basic infrastructure, and build a financial services business around that. That's something that's like really compelling and probably set up in like the right timeline. And then, on the other side, it's like we have all these futuristic technologies, and a lot of my research goes into eCash and how I think that like that might be the next protocol, not layer, but just adjacent protocol that is leveraging Bitcoin as collateral in some form that could really impact financial services. The timeline on that's uncertain. This is emerging protocol, very infant, but we're building relationships and we're working towards what that's going to be in the future. So I think like when you're looking at a private capital portfolio, you want to be looking at it from the perspective of how are we allocating within these different risks exposure around the Bitcoin industry? How much is allocated to the store value function? Do we have a lot of businesses where it requires, Bitcoin to be a medium of exchange for those to be successful. And if so, is that the risk that you would want to be taking on? And where is the growth going to come from? Do we have a large allocation to lending, which we know is going to be proliferating very significantly, and there's a void in the market for that right now,
And demand,
and very, very strong demand for it. So you want to look at it there's a lot of different frameworks that you can consider this from, and I think like the shortest answer is that the private capital side is just very infant, and a lot of people are realizing that so much value is going to be flowing out of broader crypto and towards Bitcoin native infrastructure over time. And that's kind of one of the plays that's just very underinvested at this point.
Interesting.
Yeah.
Well, it also looks like to me, I mean, look, we hold Bitcoin on the balance sheet as a podcast. If Bitcoin does what we think it does over the next few years, we'll probably have one of the most valuable podcasts in the world based on our treasury.
Right.
And so it almost feels like if these companies are generating cash flow and they're putting that cash flow into Bitcoin, that you have an opportunity to invest in companies who are going to have some kind of like skewed to the upside valuation because they've got a deep treasury position, which isn't really reflective of their cash flow.
Yeah.
Yeah. That on top of it, that's yet another layer. But I mean, what we tell people, and I'm sure you say something like, don't invest in my fund, and it's closed now, so it doesn't matter. But we said, don't invest in this fund unless you have your core position in Bitcoin that you are happy with. And then this is beyond that, So, and that makes sense, to have your treasury in there like that makes perfect sense. So
your fund is open. Do you want to pitch
we're
it out
open.
if
We're
anyone's
open.
listening?
Yeah, we're Epoch VC, and reach out to me.
Excellent. All right. Anything else you guys want to cover?
I think we had a lot of it.
We nailed it, man.
This was good. Yeah, this was really good. I feel like we could talk about this for a few hours. Maybe we set up the next record podcast consecutively.
It's the institutional world is kind of it's not it's a little bit opaque, and so I think there's a ton of misunderstanding, especially in Bitcoin Twitter, on exactly how it really does work and what these guys are up to and what they're doing. Like you just have to think of it like a very slow moving beast that is just like and collectively, not the most curious in the world,
Oh yeah.
and they're paid to take a certain amount of risk and not beyond that.
Yeah, and they're wealthy, they're older, they're not as hungry. It's just like the incentives are aligned to where it's going to take a while.
I just like this idea of all these people in suits, like you referred to the zoo, looking into this zoo of people.
Yeah.
Just YOLOing and being DJs. I think we need to be doing this and they don't know
The
how.
memes,
Yeah.
And you've got like a super respected account like Lynn Alden, and she tosses out a meme every once in a while. It's like, and it's great, and I do too. It's like, just chill out, relax, man. It's supposed to be fun.
Well, one thing is like, for final words as well as like, I think on this, the private capital side investment, it's just like, what I really like is that not only is there potential for high investment returns from participating in this, but I think it's systemically the most important thing that needs to happen within Bitcoin right now is that this infrastructure needs to be progressing fast enough so that we don't have a bunch of ETF flows. Like we want flows into the digitally native system and we want to get the consumer experience there. And there's a lot of technologies that are moving, but we just don't know what the inflection point is going to be for, a massive capital flood into Bitcoin. And will we be ready in terms of infrastructure? And like, if we have this infrastructure set up too, like even, putting kind of the revolutionary aspects of Bitcoin, put those completely aside. If all you're interested in is number go up, then building out digitally native infrastructure is going to create multiples greater market size for Bitcoin in the long run, as opposed to just digital gold narrative.
Right. And digital, and you'd rather have the ETFs enhance the growth and speed the growth of Bitcoin than consume it.
Love that.
Yeah. They're like bridges to the future.
Yeah.
And Bitcoin was the same thing. Bitcoin started in a cypherpunk, non-serious way. There's all these, gambling things. It's like markets are bootstrapping And there's going to be a lot of use cases, and whole other conversation about ordinals and all these other things. It's just like what is an okay and non-okay type use case. But the fact is everything's going to start somewhere, and there's bridges to the future, and we want to make sure that the system doesn't get captured throughout that process. And
Agreed.
that means building needs to happen.
Yeah.
All right. Well, listen, appreciate you both. Anyone listening, if you haven't checked out Eric's book, Bitcoin, the Seventh Property, we'll link it in the show notes. James, you also have a newsletter, The Informationist.
The
Is that correct?
Informationist, yeah.
Yeah, go check that out. We'll put both in the show notes. Appreciate you both. We're going to go out drinking later. Thanks, Danny.
Thank you.
Thank you for listening,
Good rip,
everybody. Enjoy. All right.
All right. Thank you, bud.